starting the credit master class here at the West Dayton Library. Have lots of food here. We still have some seats that are unaccounted for. We did sell out, but there are some seats that are available. So if you were thinking about coming, but you couldn't because you couldn't book a seat, you can come on down. So let's get today started. I want to introduce one of our speakers. I have Chanel Little here. She is a senior loan officer with Fairway Mortgage Company.
Hi, everyone.
All right. Well, I wanted to have this class for not only like people that could be my potential clients, but just for the community, because I wanted people to know the importance of credit, not just to buy a home, but to set you up for whatever's next. So if you're wanting to buy that car, if you're wanting certain jobs, you need to have that credit as your foundation. And it also just sets the precedent for everything else that you're doing with your life. So if you're just trying to get more organized and that's something you're looking at, the first of the year I'm going to get organized. I'm going to get my bank account right. I'm going to pay these bills. You don't want all that credit card debt on top of you. This is a place to start, is figuring out what is in the credit, what it means to you, and how you can apply what you learn from this information towards the rest of your life. And I'm hoping that everyone can gain some real knowledge from it. Not only, just for purchases, just for their own personal knowledge, just to know that power and not have to depend on other people to give them the information. So, with that being said, I'm going to hand it over to Chanel.
How's everybody doing today? Good. So I gave you an informational package with a lot of good information in there. First, I'll start off with just telling you I've been in the business for over 20 years in the mortgage industry. I'm with Fairway Mortgage Company, so we are a direct lender. That means we process, underwrite, fund the loans in our name, so it makes the process go a lot smoother, a little bit more lenient with as far as loan terms and credit qualifications. We've been around for over 20 years plus. Our main office is in Wisconsin, but we have branches in every state. And so the first page that I provided you with is just information of when you do start the process, why use Fairway, and the steps to actually applying for a mortgage when you do get to that step. But the main purpose today, we're really just talking about credit, trying to let you know exactly what you need to work on your credit. So what I am going to really speak on is just what we look at from a mortgage perspective. But the next page in your document that you'll see is telling you about credit. So if you have questions about like how to utilize your credit, how the late payments play a factor on your credit, which normally when you're on your credit, if you have a late payment, it's going to impact your credit. So you want to try to pay everything on time monthly. When you're doing mortgages, if it's 640 or above, if you have some lates, it's really not going to hurt you, but it probably has impacted your credit score at some point. But it's not going to hurt you if it's 640 or above. If you just have a couple lates here and there, and you can't have be 4 months late on something, but if you have a couple 30-day lates or might have a 60-day late, but you don't really want to go beyond anything like that. And it's on here it speaks about utilizing your credit on here too. So that impacts your credit as well. So if you have an open revolving credit card and your limit's $300 and you spent $300 and you're at your max, that's going to take your credit score down. So you want to the rule of thumb is to keep it below 40 to 30% of what your high credit limit is where you want to keep your balance at. That's how you're going to keep your credit scores in good standings. But once you go over that 50% mark, you're going to see your score drop pretty substantially.
That's the debt to income ratio.
Mm-hmm. Yeah. So that's what that page is telling you about. So when it comes to the next page, I'm going to turn to the next page. That is telling you, I don't know if you're aware, have you heard the changes that were made in July about medical bills? So if you saw your credit scores go up after July you don't know why. Paid medical collections, they're no longer keeping them on your credit report. So any medical collection that wasn't your credit report, you paid it, they're taking it off your credit report. They extended the time period from when they're going to start reporting your medical collections on your credit report. So they're giving you a little bit more time to try to work with the medical companies to try to pay it before they actually put it on your credit. So it was 6 months that they put it on your credit. Now it's 1 year. So you got a little more time to work on it. And then any collections that are under $500, they're not reporting them to the credit bureau. So if you are reviewing your credit, if you keep an eye on your credit, you do see some things that fall under these guidelines, you might want to reach out to the credit bureaus and just see, try to get them removed, dispute them, and see if they'll take them off of there. So when it comes to a mortgage standpoint, though, in collections aren't counted against you, medical collections. So we don't even count those against you. But when they do go on your credit report will drop. But if you just took it off just to try to qualify for a mortgage, it's probably not really going to impact your score much. But when it does go on your credit, it will impact it. But when we're looking at it for a mortgage, we don't even consider medical collections at all. We don't count that against you. So on speaking on that, when we're trying to qualify you for a mortgage, charge-offs don't count against you. So any charge-offs when you're starting to work on your credit and you're looking at like, hey, what should I start working on to pay off on my credit? So charge-offs, we don't count against you. That's basically the creditor's not pursuing you anymore. They're not coming after you. They just wrote it off as a profit and loss. They're not going to come after you for the debt. They just pretty much just charge the debt off. Collections, if you're focusing on your credit, you want to really try to just start there. I wouldn't worry really about the medical collections unless they fall under this form, but you want to just do non-medical collections. I would try to settle on them. So the creditors will settle on them. You just want to call them and see. I mean, you can throw out a figure and then worst case, they'll just come back and tell you, hey, this is what we'll accept. Or you can set up a payment plan with them to try to get the debt off. So that's where you should start at with collections. On our end, when you're looking at a mortgage, if your score is over 640, we don't require you to pay collections off, but we will factor 5% of the balance into your debt to income ratio. So if you had a high collection, if they're really small, it might not hurt you. But if you have a high collection, we're using 5% of that balance in your debt to income ratio, you might have an issue with qualifying for the loan amount that you want to qualify for. So that could play a factor. So, if you have free money available, then you probably should just work on paying, settling on your collections, and then you won't have to worry about that, hurting your debt to income ratio. But if your credit score is between 600, because we go down to a 580 credit score to qualify, but if your credit score is 600 to 620, then the underwriter could require you to pay off your collections when you go through the process if you don't have like an extenuating circumstance. If something has a major happen that caused you to get these collections, they're probably going to want you to pay them off. So that's something you want to keep in mind as well. Do you guys have any questions about collections, charge-offs?
So if you have a way when you contact them to know the difference, like if it's in collections or charged off, because what I know is a lot of the time they'll send it to a third party person, but you don't know if that's a part of the parent company or if it's actually been charged off.
Your credit report should tell you if you monitor your credit on any site. You can monitor your credit free on Equifax, Experian, TransUnion. You can create a username and password, and you can monitor it for free on there. Credit Karma, it's good to just look on Credit Karma. You can see your credit report on Credit Karma. Wouldn't really go off of those credit scores, especially applying for a mortgage, because each thing that you're doing uses different scoring modules. So, like if you're applying for a car loan, they're probably pull a different credit score than if you go to apply for a mortgage. If you're applying for a credit card, they're going to pull a different credit score. So you wonder, like, well, this company pulled this. Why are you pulling this? But they use different scoring modules. So Credit Karma is a good place where you can pull your credit report up and look at it, but I really wouldn't hold strong to the score it's telling.
Okay, but it'll say whether it's in collection or charged off.
Yeah, it'll tell you charge off or collection. So, any more questions about charge offs and collections?
So what if you have you might have like multiple medicals, and like say if there were like 300-400, would any of all of those under 500 will get
They should be, yeah.
Okay.
From what they said, I mean, as long as they're under $500, they should not be on your credit report anymore. So I would at least dispute them or call them. So, and speaking on disputes, when you're applying for a mortgage, if you have disputes on your credit report, if your credit report, if it totals over $1,000, your disputed account, then we have to remove them from dispute. because underwriting doesn't allow you to have any accounts in dispute. And the reason why is once you hit dispute on that account, it's really like it's not reporting on your credit. So it's not reflecting your true credit score because it's kind of like you're disputing it. They're not counting it against you because it's in dispute. So sometimes as soon as you remove that dispute, your credit score might drop, and when you start the process on a loan, because we can remove them on our end for you quicker. But I've had cases where I had to remove a dispute because underwriting said, hey, you got to remove this dispute because I didn't catch it up front. Usually I catch it up front. And the credit score dropped a little bit because it wasn't showing the true score. So that's something you could do if you know you're going to apply for a mortgage like in the next, couple months. You could just call the credit bureau and just get the dispute taken off so so your true score is reflecting.
So did finance score going down did it affect them on getting a loan?
No, it didn't affect them. So it dropped a little bit to qualify for the grant products that we have. But I have something called a credit analyzer, so I looked at a quick fix to help them try to get the score back up. But yeah, I mean, it could be the border of you having a 650 for a grant, and then next thing you know, you can't qualify for a grant. So you just want to be careful when you're disputing things or when you're about to apply for a mortgage, And then when I pull somebody's credit, I'm gonna look at that too. If I think you need to remove it before I do the pre-approval, I'll tell you, and I'll look at my credit analyzer and I could click remove dispute to see how it's going to affect your score too. So that's what happens when it comes to disputes. And then frozen accounts too. So when you're going to apply for a mortgage, you want to unfreeze your credit scores because we can't pull your credit score in if it's frozen. So you just want to unfreeze it for just like 24 to 48 hours until enough time to get your credit score pulled in. Is there any more questions about any of that information?
Now, when you say freeze, what do you mean?
Some people put credit freezes on their credit if they think.
Okay, pull it.
You can lock
Yeah, you can lock it in case you think there's some fraudulent activity or you don't want. I mean, just so you can monitor when your credit's getting pulled. So people just put freezes on it.
Okay.
Yeah.
So until you want it to be pulled.
Yeah.
Yeah.
Mm-hmm. Yeah. Because if you set up online, they'll ask you if you want to lock up your credit score. But if you're
Equifax, it'll let you lock it.
yeah.
But you're just locking them. You're not locking the other ones.
Mm-hmm. Yeah. Any more questions about that information? No. Okay. The next page in here is just giving you information about seasoning period. So if you have questions about if I file bankruptcy, like a Chapter 7, how long, does my Chapter 7 have to be discharged before I can apply for a mortgage? So if you look under the top one, conventional on the left, it's telling you that conventional, you have to be out of your bankruptcy for 4 years after the discharge date for a Chapter 7, and then foreclosure 7 years, FHA's 2 years after a bankruptcy. VA's 2 years after a bankruptcy, and the USDA is 3 years. Now for a Chapter 13, you can purchase while you're in the Chapter 13 as long as you made 12 months on-time payments. But you want to purchase while you're in the Chapter 13 because as soon as it's discharged, they're going to go off that discharge date and then you'll have to wait the waiting periods of the 2 years. So you'll want to buy before it actually gets discharged. The trustee will just have to sign off on it. But someone can actually purchase if they're in Chapter 13.
I didn't know that.
Yeah. Mm-hmm. And then it just shows you credit score requirements. So again, we do FHA goes down to a 580. Kind of harder to get approved at a 580, but if you have a stronger co-signer, say husband and wife, you have a 580, they have a 650, then you would be fine. But if you're doing a 580 by yourself, it's a little bit tougher to get qualified. You usually prefer 600 or above. It's usually where the credit scores need to be by yourself on the loan. And any questions about this information at all?
What about kids? Kids, you have any
Any
questions?
questions?
Diana, you have any questions?
So like when you lock it, is that like when I go into my car and I lock it, it's the same thing? Is that simple?
No, well, but online. So you would go
Yeah.
online on Equifax, Experian, or TransUnion. They would give you the option to lock your credit score if you wanted to freeze it. So only way somebody can pull your credit is for you to give permission. You have to unlock it for somebody to actually access your credit report. Yeah, that's a good question. Any other questions about this particular information?
Could you, or at least some of them, I kind of know, but
Mm-hmm.
kind of tell the cons and pros and cons just a little bit about bankruptcies? Because I know in my world, my previous job, I would say, just their bankruptcy where people are like, this big no-no,
Mm-hmm.
but is there, because they made it harder, before maybe anybody can kind of claim bankruptcy.
Yeah.
But now they kind of made it harder where they're like, we're not going to mess with you until you got this in order.
Mm-hmm.
Or sometimes people are like, they really have so much debt out there, they're like, this is my only way to get out of it.
Yeah.
Going through a bankruptcy.
I just think it's the own person's personal situation. I mean, like you said, if you're sitting down with the bankruptcy attorney, they're going to look at everything and they might feel like it's not necessary for you to pay it. They might think you fall under Chapter 7 where you could just write it all off and just move on. Or they might think you fall under Chapter 13, I think it's based on your income. Then you have to pay it back in payment. So I think it's really everybody's personal situation. If you have a lot of debt, you feel like you have to file Chapter bankruptcy. I mean, I don't think it's a bad thing. You just know if you want to go buy a house, then this is how long you're going to have to wait from that discharge date. So when it's actually discharged, not from the time you file it, when it's discharged on the court records, you see the discharge date, we're going to go off that discharge date. So, and then also to circle back, another thing about the credit, if you have any state tax liens that show up, federal tax liens, those have to be paid off. When you pull your credit on Credit Karma, you're not going to see those. So when we pull your credit on our end, we pull something called a judgment and lien section of the credit report, and that's where it shows up at. So it'll have that on there. State tax liens, federal tax liens have to be paid off. So I just give you the number to the Ohio Attorney General's office. You can call them. A lot of times for state taxes, they probably have took some of your returns. So if it was from back in 2019, 2020, you probably don't owe as much as you thought you owe. That's showing on the credit report. It might be less.
Or this might be something that needs to be released. So like
Yeah.
if you get a lien, you have to get it released.
Yes, you have to get a release. So if you pay off a lien, you get something in the mail saying you have a lien, you paid it, you just want to give that lien release document to the courthouse, to Montgomery County, so they can just show the release date on your credit. If it comes to a judgment that's on your credit, you either have to pay it off, or you have to have a payment plan, a consecutive 3 months on-time payments, pay a payment plan set up with this creditor. But if you have that, then we just include that monthly payment in your debt to income ratio, but it's fine. You don't have to really pay it off. Any questions about that at all, anybody? Okay. All right. And so the next page you should come see should just be a document checklist. So when you are considering starting the process with purchasing, it just gives you a checklist of the documentation that you'll need to have ready. So you'll see we really just need W-2s as far as your tax documents, unless you're doing a grant. If you're doing a grant, we need tax returns. If you're doing just a straight FHA loan, all we need is W-2s. Sometimes if like somebody has a side business, then we don't, and you have a write-off, the profit and loss, and you have a loss on your profit and loss. If you're doing straight FHA, then you're fine. You don't have to worry about any of that. You just have to provide your W-2 information. So this just gives you a checklist of what you'll need when you really consider trying to buy, what you need to have together. Okay, and then the next 2 pages just talk about down payment assistance. So when you're ready to buy, I mean, a lot of people have the myth where you have to have 20% saved up to put down.
Well, that's what Realtor.com and Zillow tells you.
Do they really?
Yeah, they say like they always show you what your payment will be if you put down 20%.
Yeah.
And I'm like, why are they on
They
your
do.
buying? It's not that. All you need is 3.5% if it's this or 5%.
Mhm.
It's not 20%. So everyone
Yeah.
thinks they got to bring 40,000 to 10.
Yeah. And then that's why people say, well, why are you giving me a different payment than Zillow's giving me this payment? I'll say, look at the fine. It's based off of 20%. Look at the fine print. It's saying this is 20% down. This will be your payment. That's why it's showing a lot lower when you look at the house payment on Zillow when you're looking at a property. And that's wany it's showing lower, because it's based off of 20% down. And sometimes when you see advertising with interest rates, like if you go on a bank's website, any bank, you just want to look at the fine print, because a lot of times it will say this is if you have a 720 score, this is if you have 20% down. So you just want to make sure you're looking at the fine print. But in actuality, conventional, you can do as little as 3% down. FHA is 3.5% down. BA is 0% down, and then USDA, if you're buying in a rural area, is 0% down.
Wow.
Yeah.
So Springfield
So-
right now is doing those USDA products.
Really?
Yeah.
Zero down.
Yeah, 0 down.
Zero
So then
down.
so 0 down, all you have to worry about is really your closing costs
Mhm.
portion of it, which would be like your processing, underwriting, title fees, setting up your escrow account for your taxes and insurance. That's really what you got to worry about. And that's something, your realtor could try to negotiate for the seller to pay for some of those fees.
Right.
So, but going back to the down payment, if you have to go the FHA route, 3.5% down, there are grants to help you. So the first flyer is OFA grant, which is, both of these grants are Ohio grants. So OFA grant is, they have a 2.5% or a 5% down, but your score really has to be 650 for those. And the next grant is Chenoa, which is 3.5 or 5%. You have to have a 600 score for that.
That's not
So,
bad.
yeah.
600? Wow.
Yeah, a 600 score for that. So that's really good. But where OFA is just your mortgage loan, but they take the grant portion and they attach it to your title for 7 years. If you don't sell or refinance, then it just falls off your title. If you refinance or sell, you just have to pay the portion that's still owed back. If you refinance, we'll just refinance it into your loan. If it's saving you enough money, it makes sense. You just do that. Or if you're selling it, you just get enough proceeds to pay it. With the Chenoa grant, it works. You have your first mortgage, and then the Chenoa grant is actually, the grant portion is a payback. So it's a second mortgage based off a 10-year term, and you're making monthly payments on that grant, but you can pay it off whenever you want to. So say, get tax returns, get extra money, you could just go ahead and pay it off if you wanted to. So outside of these two grants that we offer, there's also local grants if you don't qualify for these that you could look into through the Homeownership of Dayton Center. So they have specific grants just for Trotwood, Harrison Township, Jefferson, or they have the City of Dayton, Northwest Dayton. So that's something you could look into as well for your grant products. So the biggest thing, I feel if you're considering wanting to purchase, it's always good to just have a loan officer pull the credit, so we can pull the accurate credit reports. You can see what score we're pulling. Sometimes I have an easy fix because I always look at it on my credit analyzer, where I can say, okay, it's just this credit card that's at the max that's keeping your score where you're not qualifying right now. So just pay this down to this balance, give me a statement, and then I can get the credit score up in 5 to 7 days. Versus if you do it on your own. Now, if it's a long-term thing where you need to work on some things long-term, we actually have a credit tool department that I could put you over to free of cost, and they help you. They look at your credit, they tell you exactly what you need to do, and they work with you over 6 to 12 months to get your score up. So it'll be a little bit longer term, but it's at least there's always some sort of plan to get you to your end goal of buying. Yeah. Does anybody have any questions about that? It's a lot of information. Yes.
I'm just, because I got in a little bit late.
Okay.
And I'm going to speak in a moment about credit. But
Okay.
generally with people I deal with, because you were speaking about collections and so forth and judgments, I generally have people, because my general rule is to settle this out if you can't afford to pay it. Because ideally, say someone owes a T-Mobile bill for $1,000. A lot of creditors, collection agencies that I deal with, they'll sell it out for 50% to 40% on what they do. But ideally, since you're talking about loan financing, how do they generally look at that for them?
It's fine if you settle on it. As long as it shows zero balance, they don't care what you paid them to get it, as long as it shows zero balance. So it's not going to hurt you if you pay them whatever they will agree to. It'll just, your credit report, it'll mark paid, settled, but it's fine. Yeah. It just has to show zero. But I mean, a lot of them, if you can pay it, I would say pay it. The charge-offs really don't hurt you, but if I look at my credit analyzer, sometimes if I mark a charge-off paid, it might jump your score up, and then I would have you pay it.
Okay, I got a question. Like, I paid a lot of stuff off on my credit, and it's still it says zero, but why is they not taking it all the way off?
You have to request.
Yeah, you would. Well, they're not going to take it off your credit report completely. They're just going to put it down to zero. Some companies will. So when you go to pay it, before you pay it, you should ask them, hey, if I pay you this money, would you take it off my credit report? Some people will say yes.
It's like my student loans that I don't paid off. It's like a lot of stuff I don't pay off.
They lazy.
No, they keep it on there because technically it can stay on there. I think 10 years, 7 to 10 years or something.
It's 7 years, but you have to go on there and request the charge off, or you have to dispute it with each credit bureau.
Sometimes they'll take it off if you dispute it. Sometimes they take it off.
A lot of times
the credit bureaus just go ahead and take it off. If they call the creditor and they can't reach them to verify anything, they take it off of your credit. But they're not automatically necessarily have to take it off just because you paid it. But before
I
you
mean,
pay
even
it,
though it's still what they balance is zero, so it shouldn't
it'll
hurt
stay
you.
on there. Yeah, it won't hurt.
Sometimes,
Shouldn't
but I
hurt
like-
you.
I would not.
Yeah, I know. You just want it off there. No.
That you pay, that'll be enough.
Yeah, yeah, but usually I would before you even call them. When you're calling them and saying, "Hey, I have this money to pay you," I would ask them first, like, "Okay, if I pay this, will you take it off?"
Right.
Just to see what they say. There's some creditors that say, "Sure, we'll take it off as soon as you pay it."
Right.
So it doesn't hurt to ask. Any more questions?
Robert, do you have any questions?
No, they've answered like a lot of my questions have been asked.
Okay.
Oh, okay.
And
Okay.
She's
Good.
answering questions.
I
that
talk
I've
fast,
asked
so
before.
please tell me to slow down or tell me to answer something else again. And we do investment property purchase too. So we do investment property. There's a program with Freddie Mac, part of conventional, might be able to do 15% down, but it depends. Typically it's 20% down for a single family unit, 25% down for a 2 to 4 unit. And it has to be conventional financing. So
Is there a PMI on that? Oh,
if you're putting 20% down, no. Yeah, no. So as far as anybody know what PMI is? Have you heard of PMI? Okay.
Kids, do you know what PMI is? I just talked about this. This means you're not working on
So it's
PMI.
private mortgage insurance really protects the person who's backing the loan, like FHA conventional. And so if you're conventional, if you're putting 20% down, you won't have PMI. It's based off of your credit score on conventional and your debt to income ratio. So it's going to be, depending on that, what the percentage is going to be of the mortgage insurance. If you're putting a little bit, not actually 20%, but 15%, then it's probably going to be a little bit lower. But on conventional, once you reach 78% loan to value of what your house appraises for versus what you owe, you get asked to get it removed. Okay, FHA, you're going to have mortgage insurance regardless, but it's based off of a certain percentage. It doesn't change, fluctuate based off credit, based off that the income ratio is 1-7%, and it stays on the loan for the life of the loan. So if you start off with the FHA loan, you could always work on your credit. You see your scores going up pretty high. Then you could refinance onto a conventional loan, and you could, if you paid the mortgage balance down, you could possibly not have PMI eventually.
So how are multifamily dwellings viewed? Are they viewed as primary residence or are they viewed as income properties?
It depends on how you're buying it, and you can purchase it as a primary residence if you want to live in one unit. So then you could do FHA, and you could still get a grant as well.
Right.
So you could buy it, live in 4 unit, live in one of the units, and buy a 4 unit. If you and then if you just do an investment property, then you'd be looking at putting 25% down.
Right.
So if it's your first time home, I mean that's a great way to go. If the
Right.
space is accommodating to you, you could just get one. Live in one of the units.
And doesn't that count towards his income? So say he's buying a 4-unit apartment and the rent is $1,000 in every like a unit is
Mhm.
$1,000. That's
Yes.
$3,000 a month will count towards your
Yeah,
monthly income.
we could use
If
a
you
percentage of that.
Rent the one you're renting one yourself basically, but
Mhm.
the other people are paying your mortgage, and you also can get a profit that goes towards your income.
Yes. So when you're buying the property, if you were going in and buying a 4 unit, you're using one of them, all the units are rented out, we can actually get the lease agreements and use a portion of that rent to count it towards your income to help you, your debt to income ratio.
How long would he have to stay there in order for him not to have a penalty for moving if he was using it, the first time home buyer marketing it as his? Would he have to be there for 5 years?
I believe it's at least a year.
Okay.
Mm-hmm. Yeah.
So
But not to cut you off, another thing is if you're getting another loan and you have an FHA loan on your credit already, and say you moved out of this property, but it's financed by FHA, then you're going to have to get a conventional loan because FHA government loans only allow you to have one government loan at a time. So you would have to get conventional on your next property that you're buying as a primary residence.
So if you buy the multi-unit as first time home buyer, primary residence,
Mm-hmm.
that will be up under, you do that up under FHA.
You
Mm-hmm.
can do either.
You could do
Mm-hmm.
it.
Yeah, conventional FHA. Mm-hmm.
So say for instance, you do it as an FHA and you stay there for years
Mm-hmm.
and then you decide to do a different property,
Mm-hmm.
then would you have to convert that FHA to a conventional? Or would
No,
the next property have to be a conventional?
the next property would have to be a conventional. If you haven't refinanced that one or anything and it's still showing as under FHA loan, the next one would have to be conventional.
So if you refi it, then you can end up doing another. If you refi it
Yeah,
as a,
you could refinance it to a conventional.
Gotcha.
Mm-hmm. Yeah, and then FHA has just a small loophole with having 2 government loans, but it's very tricky. You have to be moving a certain amount of distance, and you have to be like upsizing your family has increased substantially. But you have to. It's hard. I mean, I wouldn't bank on that, but it is certain loopholes. Yeah. Is there any more questions?
I just have a couple comments if I can make.
Sure,
I'm a
yes.
officer. The 2 things I would just like to say, you can address this too. We have about 30 days left in the year.
Mm-hmm.
So if if anybody does want to take advantage, you can call your credit bureau right now
Mm-hmm.
and get your free credit report. It's going to count towards this year. That way, when the new year starts, it starts all over again. You get one from each the agency. They're completely free.
Mm-hmm.
So obviously, you can also kind of you can say,
Yeah.
like, if you haven't got your credit check this year, you can.
Yeah.
And
Free report.
for all of the 3 agencies, and it'll start all over at the beginning of the year.
Mm-hmm.
And then the one, it just made me point out we have some young
Mm-hmm.
people here, audience.
Young people. Talking about that.
What I've heard, and you can tell from your experience,
Uh-huh.
if people in the household they have established credit, they can add their young children on as authorized user
Mm-hmm.
and kind of help build their credit
Yes,
up
that'd be
until
great.
the age of 18 or 19.
Mm-hmm.
So I just wanted to get that out there.
Yeah, that's a great thing. That's good to point on. Yeah, that's something you can do for your children to help them build their credit. Mm-hmm. Yeah. So, and just one more thing I wanted to touch base on too. So when it comes to a down payment too, say you don't have money saved up, if your credit score is 640 or above, then typically, you can get a gift. So you can use gift funds from a family member, or you can use 401k. So in 401k, they're easy to give it to you when you're purchasing a house. So that's something you want to keep in mind too. You can always utilize those funds for your down payment. So, any more questions?
I have a question.
Okay.
I've seen a lot where it's like bankruptcy, like a good thing for big businesses when they're just trying to look for a way out. Is that true? Like, I'm kind of confused on that.
I really can't talk on that. I don't know much about the business side as far as businesses found bankruptcy. I mean, people have. Yeah, businesses do it quite frequently if they are in trouble, basically, if they're experiencing a loss.
Bankruptcy really, I mean, you see corporations do it, but your corporation bankruptcy versus you filing bankruptcy are miles apart.
Mm-hmm.
I mean, they can file on debt, and it's basically going to Chapter 11 for the most. And there's repayments and things of that nature. And then it also varies between levels of creditors and so forth, where you as a person who files bankruptcy, you're only dealing with secured credit holders, the government, which also includes child support and income tax, and then just regular debtor, creditors. So it's miles apart. You see big businesses file all the time, but generally, say American Airlines filed bankruptcy in like 2 or 3 years ago. The company doesn't dissolve. Where you filing on your LLC, you can dissolve the company, but it affects greatly different, and it's a totally different scope of things. So
That was an excellent question.
Mm-hmm. Does anybody have any more questions for me that I can answer? Well, if you think of any questions, my information is on the flyers. So you can always reach out to me, give me a call. My email address is on there, email me. If you want to just have me look at your credit to see where you're at, if you're able to qualify for something I can help quickly to get your score up if you're not there, or if it's something you need to put a plan together. I can talk to you about that too as well. Okay.
And I definitely like, just to give you the praise, like when I went through the home buying process, Chanel helped me. She was my loan officer, and she held my hand. And I was also my own realtor during the process. But she held my hand through the process because there was times I wanted to cry, and we got through it, and we got it done in 30 days.
Yeah.
So, I would say, I'm just saying.
So yeah, I would do all I can to try to help you. So just call me or email me if you have questions. It's fine.
Well, thank you.
You're welcome. You're welcome.
All right, well, we have our next speaker here, Mr. Corey Lee. He's an attorney and he deals with the credit and bankruptcies and taxes and all those finance questions that you might want to ask. He probably has answers. I don't always have all the answers, so I generally call people I know, and he's one of those people I call when I can't answer the question.
I apologize. I'm a little dressed down because was
This
running
is
a little
fine.
bit late, and I had a meeting actually dealing with someone with credit. I generally tell people the biggest.
step over you.
That was good, but generally I tell people there's a reality about credit that a lot of us don't understand because unless you come from an affluent family, things like this aren't generally discussed. Dinner table, in your group of friends, in your circle. A lot of things I had to learn growing up the hard way because a lot of you are younger. Your first year in school, for me, on the corner was a guy offering a credit card for this, credit card for that. Because as you're young, they'll give you a credit card for anything. But they don't talk to you about the long-term goal of things, of actually paying it off, dealing with how much you're actually paying into something. Because I tell people, say you have a $500 credit card and you're making your minimum monthly payment. That $500 credit card is going to quickly turn into at least $1,000 that you're paying off. Where we just think, well, I just pay $25 and I'm okay. But realistically, you're just basically throwing money in the fire pit and burning it away instead of just ideally spending $500 on something and paying it straightforward. The other thing I talk to people about is actually understanding what you pay in the long term as far as with car loans. And it's jokingly, but I tell people if you see a car commercial for getting a car here between 12 and 5 when people are generally at home sitting, don't go there because a lot of people I deal with JD Byrider, CarMax, Credit Acceptance. Companies like that, ideally, we don't look at what we're actually paying for the long term. I use a client as an example. She financed a car for $9,000. The car itself, where she bought it from, was ideally probably worth about $7,000. And I asked her, I'm like, do you understand what you're paying for? She was like, yeah, I'm paying $430 a month. I'm like, no, you're not paying $430 a month. That's your car payment. If you turn up to the back page, and a lot of companies, because of the credit lending acts, they show in the back that how much you're actually paying in the long term. So that $7,000 value car she was paying that she financed for $9,000. By the time the 4 years was over, she was paying $34,000 on the car. And it's a shock because people are like, I didn't know. I'm like, because we just look at what our monthly paycheck is and how much we have coming out.
Right.
But it's always about the long term. So she's financing a car loan at 20% because a lot of the car loans that you see Drive Time and all these companies, they finance, they're just the front person. The company that they finance through, ideally, you're paying at least 20% up to 29%, which is basically financing a car on a credit card. And you never want to do that. I was explaining to a client today, she was looking at a judgment for a payday loan, which payday loans, I get you getting a pinch at times, but ultimately they're not your best solution. They're a last means solution. But when you take a payday loan out, you have to understand you need to pay that loan off, that paycheck, but also account the fact that when you pay that paycheck off, you still have that money come out. So you have to be prepared to still move forward right after that and not to deal with it because you keep continually paying that, you're paying interest on that again, you're just throwing money away that you really didn't have in the first place. And so it's kind of understanding the long-term goals of what you're actually paying out versus what you think you're buying right then and there that you have to deal with. But she was asking me, like, well, I owe this judgment now. She has a judgment for about $5,000 because she took out a loan online, which you'll get times, emails all the time. Go to Lending Club, go to, I forget some of the other companies. Lending Tree. The Lending Club is another, but there's a lot of companies that you have to look at when you're going through this. Not how much you're paying, but go through. The first thing you always want to look at when you take out a loan is the interest rate that you're paying. Because even with me, I have good credit, and I went to go to Bright Pat to buy a car. And I knew how much my credit was because, again, she spoke earlier about Credit Karma. Credit Karma is a nice snapshot But ideally, it's not your real credit score. You have to go to the actual credit bureaus and find out your credit score. But even with White Pat tried to tell me my score was like a low 600. And I'm like, that's not my credit score. I know what my credit score is. They're like, well, you looked at Credit Karma. I'm like, I deal with finance all the time, so I know not to look at Credit Karma for their credit score. But they were attempting to finance me at 10, 12% for my car loan. And ideally, I should have been at 4%. And so I went to the dealership. They're like, your credit score is this. So ultimately, my loan got financed at 4% with White Pat. Right, with what White Pat was going to finance me for because they just assumed I would take it and go with it. So my credit, my payment, right, was
It's
actually
all
going to
about timing with cars, because I had a 0% interest rate on my car during the pandemic. They was giving cars away, and they gave me $500.
And with that now, unfortunately, with pandemic loans and car inventory, things are really rough right now because the computer chips and all this other stuff that goes in the car. So ideally, right now, you're paying more for a car. A friend of mine bought a brand new Suburban, and they offered him $15,000 on top of what he paid for it. He had been driving the car for about 3 or 4 months just to get the car back. So because the car is a limited shortage, so loans and stuff are a little bit more tricky right now. But ideally, when you go out to finance something, you need to always understand exactly the real payment that you're making, not that $300 a month payment that you're making, but ideally long term, what you're going to be paying. I do a lot of bankruptcies. She spoke on it earlier, as far as the amount of time it takes for you to get bought into a house. And this is a top point in time now you want to start planning. Whether or not you choose to file Chapter 7, I never would tell somebody Chapter 7, Chapter 13, because there are alternatives to paying it off. But ideally, you have to look at each of your own personal situations that I owe $10,000. Say 50% of $10,000 is going to be $5,000. Do I have this $5,000 to pay off? Whether or not the creditor wants their percentage of that $5,000 right now, or if they'll take it 6 months, they all differ based on who they are and what the bill and how much you owe. But a lot of times you can settle out. People are like, well, they're about to sue me. And I tell people, about to sue you and sue you are two different things. I can call you all day long, threaten to sue you, but when that document from Montgomery County or Dayton Municipal shows up at your house, things are real. Don't ever let it get to be that point, because at that point in time, things go greatly out of your hands. There are some legal loopholes I'll use with people at a time, because a lot of times say, I lived over on Salem Avenue, but now I live over in James H. McGee. They'll serve me in Salem Avenue, and they have to have proper service to serve you. So if they serve me there, and all of a sudden they start garnishing my paycheck, me as an attorney, I can call right down to the courthouse. I never got service. That doesn't mean that the suit goes away, but it stales it for that moment, because they have to actually serve me over on James H. McGee. Thank you. So there's always little legal loopholes, but that doesn't ultimately resolve your issue. So don't ever let it get to that point where they're sending you something in the mail, because at that point in time, if you're working over at Miami Valley or the car wash, I don't care. They figure out where you're working at, they're going to garnish your paycheck. And I tell people, ideally, you're talking about 20% of your check after Uncle Sam gets his money and any like child support and things like that get their money. So you're dealing with that reality. So if you get something from a collection agency, don't put it off. At least talk to them. Make minimum payments, but if you can, ideally try and sell it off with them. Because the fact that $500, you make it sell it out for $200, because they don't want you filing bankruptcy. Because if you file bankruptcy, unless you file 13, they get nothing. There's no ifs, ands, or buts about it. So they'd rather have something, because they purchased the debt ideally. There are some people who just collect on behalf, and it varies by collection agency. But they would rather get something than nothing, because even in the 13, they're only getting pennies on the dollar. So that same amount, they may only get $100 on $1,000, where they can maybe get out to you $500. And if they take a judgment on you, they're going to get the $1,000 plus the attorney's fees and everything, the interest that accrues into you paying it off. So that's things you have to think about. So never, once it gets something from Montgomery County or Dayton Municipal, again, it's real at that point in time. Whether or not they garnish you right away, is going to vary with the collection agency because I've seen people get judgments and they don't bother for 5 years, and all of a sudden they're like, I'm getting garnished. I'm like, from what? They're like, I don't know. So then I'll pull up their judgment docket from the court system. I'm like, you got sued back then. Like, I didn't know. I'm like, that's because you didn't respond. Whether or not you live there or not, some people just get it, throw it away, and they actually live there. And some people, again, they move. There's different reasons that you may or may not get out of, but it's only, again, temporary that you get out of that situation. So you want to work on paying it off. Ideally, I tell people, it's going to, each of your situations is going to vary, but what you can do. A lot of people will run out to A and B credit fixing agency or whatever, and those people work a little bit, but again, it also goes into what you can pay into each month with those places because, and then as much as they say they help you out, some of them I know, because it's always a constant complaint, well, they didn't pay anybody. I've sent them $1,000, $2,000, $3,000, whatever dollars, and they didn't pay anything, or they may have did this. So, and ideally, if you're paying for them, a lot of times it's stuff that you ideally can do yourself with proper research. You know, people are like, well, you know, Sam Sneeze said he can fix my credit. There's no such thing as fixing your credit. There's either adjusting, paying off your bills, selling it, or getting things disputed and removed. And any of those things, I mean, I've had clients pay $2,000-$3,000 for these credit repair people, and their credit is still the same. They just basically gave things away. So it's really monitoring your credit. Again, Credit Karma is great because it's Experian, Equifax and TransUnion that they use, but you have to know Experian, Equifax, and TransUnion. The gentleman that spoke earlier about getting your credit. I don't know if they're still, because I don't bother as much with them because generally with Experian and Equifax, they really mirror each other, but it's also understanding to know what's on your credit. If you go down to Cashline and take out a cash loan, unless they send you to an collection agency, they're not going to be on your credit report. So things like that, you have to know. Miami Valley may not always be on your credit report unless they send you out to collections. So there's certain debts, if you borrow money from a friend, they're just as much as a credit as Chase Bank. It doesn't matter. So, but it's ideally knowing what you actually took money out for. You're not going to remember everything because even with T-Mobile or Sprint, until you go to collections, you're not going to see them pop up as much. I know T-Mobile or in AT&T, sometimes when they run your credit, they actually start a credit file on you, but not always. So nothing's ever guaranteed. It's kind of up to you to know what's on your credit or what you know who you owe. Because even if you go to Rent-A-Center, they have a collection company, and once they collect on you, they will pop up, but ideally they don't. Credit acceptance, can't think of there's a loan company now that they basically finance for a lot of people. They help you build a little bit, but it's still not ultimately the best route because if you find an item on sale for $500, but the regular price is $800. You're financing that $800. You're not going to ever give you the sale price. So that $300 that you're spending to save, to get that item now, wait and just save up the money and buy it. I mean, and people are like, well, a lot of my clients, I filed bankruptcy, I'm done, I never want credit again. I'm like, unfortunately, in this world, you can't not have credit because credit affects your home loans, your insurance, and numerous other things that you may find yourself needing to do. I mean, simple things like car insurance, I tell people to always have because a lot of my clients, they get into a car accident. And unless you're drinking and driving, you can ultimately get out of it, but losing your license and everything else is just not worth it long term. So even getting a high deductible insurance is better for you in the long run than driving uninsured. And I mean, there are a lot of people uninsured. I tell people ideally, I mean, it's rough. I know at times because of the paychecks and the amount, but keeping full coverage on your car is way better than having liability because you'll be amazed. Just because that person's driving a Lexus does not mean they have insurance. And if they hit you, your car gets totaled, only thing you can do is basically get blood from attorney because that's all you're ultimately doing. It's a bad situation and sad to say, but people are like, well, my full coverage insurance. I'm like, it's not really that much more money in the long term. I mean, and it's always looking at the short term. Like, I got to pay $50 versus paying $80 if somebody hits my car and I'm totally without a car, because you're basically stuck at that point in time. You can get a judgment against them, and some of the courts, they will put a hold on them, but again, they can go file bankruptcy and be wiped of you, and you still be without a car. So that's the thing to think about. But basically, the bottom line is always understanding what you're paying for in the long term versus the short term. And then again, with things, working things out with the credit agencies. And she spoke to it. You have a right to negotiate with anybody. Whether or not they deal with you or not, who's to say? But ideally, if you sell out something with somebody, you want that transaction in writing. So when you send them that $1,000 to pay off $2,000, you want it in writing that that's it. You're settled in full with them. Even if they sell for less than the full amount, that's fine, as she spoke to. But you can also sometimes negotiate that, again, because they want money. They don't care the terms. So you can negotiate, and I've done it for clients before that, okay, I'll pay you this $500 to get, this sell out, but I want to take it off my credit report too. But again, make sure it's in writing and go from there. Because if you don't have anything in writing or recorded or something, some kind of, variable evidence, thank you, of proof that the transaction is my word versus your word. But they do negotiate and will remove it off. I tell people ideally to always pay attention to their credit report, because I had a client a long time ago when forgery and fraud and everything were running rampant. He owned 3 houses in California, never left the state of Ohio, and somebody financed multiple homes in. And he didn't even have credit like that, but his information hit and they just dinged him.
How long did it take for him to get anything in order?
And ultimately, he filed bankruptcy because he had other credit issues. Because, I mean, he owns 2 or 3, $200,000 homes that he never doesn't even know where they're at, and he got hit up, so he had to, he filed.
Did he dispute those properties?
He could dispute them, but again, and I told him ultimately you could dispute them, but he had, other credit issues as well, so it was in his best interest to go ahead and file. Disputes, sometimes you have to go back and forth, because even now, a guy I'm dealing with his credit, he had a loan through K Jewelers. It's on his credit report. I call K Jewelers. They're like, you don't know what you're talking about, because once they send out the collection to write it off, they may just delete you from the file. So you have to basically start off at least with the dispute, and then a direct letter sometimes to these companies to get the evidence, the matter off of your credit report. It doesn't always fall off. Even if you settle something out, these companies aren't always diligent about going ahead and taking things off. Even with bankruptcy, I have clients that are like, well, this is still on my credit report. That's why I tell them, like, once you file bankruptcy, by the time your immediate creditors come, start disputing stuff to get that process rolling, to get this stuff off your credit, so your credit score starts going up. Because once you file bankruptcy, I tell people, be warned now. You're going to get stuff in the mail constantly. Get a card here, get a credit card here. I tell people, take this with a grain of salt, because don't start running rapid again, because basically you're going to be in the same position you were before, and 3 years for 13, 8 years again for another chapter 7. And I've had people come back. It happens. I mean, there's circumstances it's not always in your control that you can't help. But ideally, I want to see you, once you file bankruptcy, start moving forward and building your life, because it doesn't take long to rebuild your credit. It's just going into things like mortgages that there are time frames on, but you can start rebuilding your credit even with a car or whatever your needs are. But to take it with a grain of salt, ultimately, you want to build up your score to where you want to be at to get what you want, because paying 13% versus 4%, you're talking about a doubling cost of your monthly payment. So it's ideal to always put yourself in the best position financially if you're going to go out and finance something. Avoid payday loans, these internet loans, cash advances, all that type of stuff. Avoid that. Ideally, try and build up your 401k, because The 401k is your personal savings, not only for retirement, but in position if you have an emergency come up or you want to buy a home. That's something you can fall back on as last resort sometimes, but it is something you can fall back on. But ideally, you want to build yourself up and understand in the long term of what you're actually paying versus that monthly payment. Because that's ultimately where most people get in trouble with is they want to run out and go get something and just know, well, I can afford this payment. When really you can't afford that payment because if you go buy a $34,000 car, you would have bought a $34,000 car, not the $9,000 car. So that's basically it as far as a quick run through. I really ask questions and it makes it a little bit easier that way. So if you have any questions, feel free.
I would just, because I've seen this and I'm not trying to hold up anybody, but what is, what are some of the hurdles or things for people of color or minority that you see, that you come across, that people are becoming a victim of? Because one thing I just read from the newspaper, and this is just from the newspaper, years ago you used to see these title companies where they, buy here, pay here, or these companies, auto title loans. You saw them mostly predominantly like Hispanic or Black neighborhoods. Do you have an update on those, or
It's still not so much an update, but it is a true statement. Predatory lenders is what we call them. There are some restrictions that they came out with to restrict down with what the cash advance places and things of that nature do and can't do. But ultimately, they're always going to be our neighborhoods. That's where they're at because they're not going to Springboro or Centerville because the majority of my friends that live there, they make $50,000 above. So they're not ideally unless there's a huge medical situation. I do have a friend, he confided in me, he's filing bankruptcy because of health issues and things like that. That's when people of wealth generally file bankruptcy. It has to be in extreme circumstances. But ideally, you're not going to see predatory companies reaching out to you. That's why I say with Drive Time and CarMax, you'll see them, the nifty little rap commercials and things like that run from 12 to 5. They're looking for you because they know ideally you're probably at home working second shift, but you're watching TV instead of at a normal 9 to 5. So they're looking for you to reach out to you and bring you into them. Same thing with Cashland, Ace Check Cashing. There's a few other big ones that are online, but if they're using our people to represent you and bring you in, ideally they're coming after you with the understanding that they can bring you in as a minority and take advantage of you and basically just reap benefits off of you. They're not going into middle class neighborhoods and advertising and putting businesses up because they're not going there. That's why, with Cashland, a lot of those businesses, they all run down Salem Avenue. I don't know how many are still there because of COVID and all that, but if you went down Salem Avenue probably about 5 or 6 years ago, there were several check cashing places all the way through there. And that's the same thing. You're always going to find those businesses looking out for you. The title companies, ideally, they're going to give you this money because they own your car. Even if you file bankruptcy, your only choice is with them. Once you file bankruptcy, they're almost just like a secured loan. Even though you didn't finance your car with them, they're going to give you the option of to keep paying that loan off at whatever interest rate they choose or give the car away. Sometimes they may not even get the car. I'm not going to tell you that they will. Because even with a home loan, I had a client years back, she filed did bankruptcy, and they never even bothered the home. The home didn't even move or get foreclosed or sold or anything. They didn't transfer it back or take their home back until it was like 2 years later. And she had to unfortunately deal with them foreclosing on the home. So then she had to wait even that foreclosed term again to finance a home. But you never know. Because even if I filed bankruptcy today on my car loan, right back and I'll come get the car for 6 or 8 months. But in that time, that doesn't mean that $300 I was paying on my car loan to just go burn that. You need to start building that money up to put yourself in position once you need to start building your credit again. Whether or not it's going to buy a car or going to buy here, pay here place and paying for something. But ideally with buy here, pay here places, I tell people my rule is it's better to build your credit up and go buy something that's going to last you more than a year because, and ideally you were speaking about time to buy a car. I tell my girlfriend's son was talking about going to buy a car in April. I'm like, don't buy a car in April.
September.
Yeah, you wait because
September's the time.
from right now until April, May, it's tax season. And ideally, and she says September because ideally anybody that's generally filing their taxes, if you file an extension, you're dealing to August, September by that time. But the main people who get 5,000, 10,000, 12,000, whatever it is for their tax returns because they have earned income credit or they paid in that much money to the government, they have money now. So these car companies, they bump their prices up. They're not going to negotiate with you because if you don't want it, I mean, he'll take it. That's their fault.
September's the best time to buy a car because that's when the next year models come out. So the current year get
Right.
lower. That's why September's a good year to buy a car.
Yeah,
Unless it's a pandemic.
But ideally, again, like still though, with that whole time frame, they're not gonna negotiate with you because there's a ton of people that have a lot of money just to burn, and people don't look at. I have clients now that they got 10 grand back. By the end of next tax season, they have nothing to show for it. So if you get this money back, think about what you're doing with it long term, whether or not it's putting money to actually build money versus just going out and buying a TV. I had a client like, when do I get my refund back because Best Buy has a TV for $700? I'm like, do you really need a TV? I mean, that bad. That $700, you can do a lot more. I mean, it's nice to have a new TV. I'm not going to tell you I haven't went out and bought one. But when you're living from tax return to tax return, paycheck to paycheck, going out and buy a TV sometimes shouldn't be your priority. I'm not going to ever tell you, I'm not going to be a hypocrite and tell you I won't go buy one. But you still have to think about ideally where you're at that point in time and to get ahead. Because that's ultimately your goal is to live comfortably, to be able to retire and not have to stress about paying this person off or paying this loan off or anything like that. So, but anybody have any questions? Any other questions?
Talaya, do you have any questions? What was he even talking about? Taxes, what? What about the taxes?
Don't do her. Dang.
Okay, Cam, you have any questions?
Why you combing your hair?
What did he say about the taxes?
Would you recommend a good book?
Ideally, I mean, there's not a specific book I would recommend.
Or a podcast?
Podcasts are great to listen to. I'm not a social media person. I'm not even gonna lie to you. I mean, there's things I'll look up, but you have to understand for everything that somebody's going to tell you over here, somebody else is going to tell you over there. So you have to use your own judgment and kind of listen and weigh. There's always a meeting in the middle.
Discernment.
Right. Because I tell people as an attorney, there's your story, their story, and there's what's in the middle. And that's how everything that you find on the internet, anything else is, you have to, do your research and not just, well, Joe, my friend Joe told me this, because I have people like, well, Joe said I can do this. I'm like, what does Joe do for a living? He's a janitor. I'm like, well, I'm an attorney. What do you think that means? So that's, it's great to listen to people that have been there, done that, but still always do your own research because that being here, done that will put you in the same position as they are, where you're even worse. So I always think that. But that's pretty much it. Oh, go ahead.
So you said earlier Credit Karma is not really a good place to look. But like when I'm older, when I try to start building my credit, should I look there first or should I look like with a credit bureau?
You can, Credit Karma, everybody has access to Credit Karma. It's great because it's free. But it's only a snapshot. Ideally when I start financing things, I know I went and bought something here, bought something there in our finances. So you should already have a general idea what's on your Credit Karma or your Equifax, your Experian, your Attorney's Union. When you get ready to go finance, go to annualcreditreport.com once a year. I don't know, again, like I said, they were at one time allowing unlimited because of the pandemic situation. I don't know if they're still doing that, but go to annualcredit.com and pull all 3 credit reports. You don't have to print them out. People always want to print them out. I'm like, please don't print them out. Save them as a PDF because that's what your smartphones, your computers, they'll allow you to save it to your PDF, and you'll always have access to it versus having to keep up with 20, 60 pages of paper. Yeah. But yeah, but Credit Karma, like I said, it's great to kind of peek in the window. But if you want to walk through the door, go to the credit bureau and pull that actual credit report. A lot of places, they vary on who they're going to use, and you can ask some of the banks. They'll tell you, I'm going to use TransUnion, I'm going to use Equifax, Experian, but know it's on all three. They should. TransUnion deals a lot of more smaller stuff, smaller collections of stuff that you don't generally see, where that same information may not be on your Experian or Equifax. And I generally find that true, and that's why when I deal with people, I tell them at least pull those two, just to know ideally what's out there. But if you think there's something missing, to pull the third. But if you're trying to finance, pull all three, know where you're at, and know what you need to deal with. And again, call and negotiate. There's no harm ever in being told no. You just told no. But at least you made the effort and attempt to do something that's going to be beneficial to yourself instead of just paying them $1,000 when they really only took $600. Because again, that's money towards your down payment, towards your food bill, towards your cell phone bill, whatever, or money you just put in your pocket. So it's always about, yeah. Oh no, I'm good.
All right.
All right, take care, everybody.
Bye. Thank you for
Do you have
coming.
business cards or
I
anything?
don't right now because I
Okay.
Faye has my information.
She
If
does?
anyone
Okay.
has Winston's
Okay.
number, I will give it out if
Yeah, I
that's
have
okay.
no problem with it. So.
Okay.
She has my information, my email, but yeah, I apologize. I was really
Okay.
praying for a meeting with like,
Yes.
Okay. All right. Thank you.
Mhm.
Thank you.
Thank you.
You're welcome.
Thank you. So, does anyone else have any comments or any questions about anything? All right, Amber.
No, I just don't even think about Facebook.
All right, well, bye Facebook. We're about to get a little bit more intimate, ask some other questions. So I will see you guys later.
Because your phone was about to die anyway.
Yes. I was wondering. I said, wow, my battery's holding on today, and it usually doesn't.
So now I'm screaming.
So,
Here, I don't know if it's like, 30 days or forever.
30 days.
Yeah, that's the one I like.
Mm-hmm. All right. Well, okay. Usually, like with my personal experience with credit, like he was saying, when you turn 18, they throw all these credit cards at you, student loans. I could take out whatever I want, but I was really good about not taking any student loans out when I was at Sinclair. Yeah, I managed to get out of there with no debt. Then I went on for my bachelor's degree, and that's when I got student loans and all that stuff. But before that, I had credit cards, so there's all the different things going on. But now that I'm in my 30s, I'm like, oh, I know how important it is to get this stuff in order, keep it in order, have this set up. But if I could let them know that their age would be great.
Yeah.
So